First of all, thank you very much to give me the opportunity to present this paper. So it's a joint work with Sida Lee, who will be on the job market this year. So we ask a simple question. It's like, suppose you're a CEO like Bezos, how do you choose the nominal price for a stock? So that sounds like a difficult question, but you need to balance two things. So there's a trade-off between two frictions. So think about the most economics model we learn. There are two important but implicit assumptions. It's like both price and quantity are continuous. But in reality, both of them are discrete. For price, we have discrete tick size. So if you choose a very low price for your firm, you will face something called tick size constraint. Why? Because in US, the proportional tick size will decreasing in nominal price. If you choose a low price, let's say if you choose the price of $2, that means the proportional tick size is 0.5%. And Yao and Ye show lots of low price stocks often have exactly 1 cent bid-ask spread. Why? Because they cannot go low. So tick size constraint actually reduce liquidity. But then how can maybe you can do the opposite? You choose a very high price, like Amazon. Let's say 1,000, 2,000. So if you choose high price, you don't split. You face another thing, which I will show you. It's called lot size constraint. Why? Because for most market makers, you need to display at least 1 minimum lot, which is 100 shares. So 100 shares of $1,000 is $100,000. So market makers' obligation to display the minimum lot will increase with nominal price. So if you get sniped, just as Marius presented, it's like that will increase adverse selection risk. So market maker again will reduce liquidity because of large lot size. So what is our main findings? Okay, if you're a firm, you try to minimize spread or maximize liquidity. We find something we call the golden two-tick rule. So optimal price depends on lots of variables like volatility, tick size, volume. But all firms achieve their optimal prices when their nominal bid-ask spread are 2 ticks. So before I go to the detail into the model, there's a simple way to understand that. It's a marginal condition. It's like the contribution from the tick size is 1 tick, always. So you need to split or reverse split your stocks so that the contribution of tick size is equal to the contribution from the lot size. Okay, that's the first result. And then the question is, how can you split your stock? We discovered something called a modifier square rule. It's like if you observe your current bid-ask spread divided by tick size minus 1, take square root, that's the ratio you are going to split. So we also have empiricals for our results. So it's like stock splits increase liquidity if they move bid-ask spread closer to 2 ticks. Again, it's closer, okay, to 2 ticks. And then we develop a parsimonious 3-factor model. It can explain 84% of US stock liquidity. So the 3 factors are tick size, volume, and volatility. And liquidity channel also explain 1/3 of announcement return after splits. So finally, we talk about policies, about different, it's like a policy regimes. For example, now we are in Europe virtually. In many European countries, we have proportional tick or lot sizes. We will make a comparison between different policy regimes. So first, let's talk about the model. So there's 3-stage model, 5 types of players. So in stage 0, there's a regulator, choose lot size L or tick size delta. At stage 1 is like a firm with value V chooses its share price P. So H is V divided by P. So you choose both nominal price, you also choose your shares outstanding. And the firms aims to maximize expected utility measured by proportional spread. So stage 2, actually, Marius have already presented. It's a trading game. It's like a market maker set a competitive bid-ask spread. Let's call it ST. So the security value evolves as a compound Poisson process. So the intensity of jump is lambda J. Basically, it's how often they jump. And the size of jump is it's sigma VT or minus sigma VT. Basically, it's like sigma %. Either you go up or go down. And the market maker choose ST given PT, which is chosen by the firm, and also L and delta chosen by the regulator. And the informed trader aims to add a select market maker after value jumps. And the investors, or you can consider them as uninformed trader, arrive with intensity lambda I, each of whom have inelastic demand to buy or sell VT. So let me give you a motivating example, actually a special case nesting our model, which is a famous paper by Budish, Crampton, and Shing. So BCS, and also which is also Myers model based, it's like they do not include a regulator and the firm. So you can also consider it's a special case in which regulator and the firm make suboptimal choices. So in stage 0, in Budish, Crampton, and Shing, they choose continuous price. But remember, the lot size is discrete in BCS, which is 1. 1 can be anything, it can be very large, okay? And in stage 1, the firm also make a mechanical selection, so they choose a price equal to its value, which is P is equal to V. So what will happen? So in this case, the lot size is binding. So traders and market makers cannot further divide their demand into smaller units. And then traders interact, that's Budish, Crampton, and Shing, on the 3 parameters: continuous price, lot size equal to 1, and P is equal to V. So what we are doing, we study a more general model. So first, let's think about that. It's like a firm can choose P, given tick and lot sizes. So I will give you a motivating example, which is the same lot size and the same tick size as in BCS, which is continuous price and the lot size is equal to 1. So later we'll talk about current US regulation. It's discrete price and discrete lot. I will first show you theory, and later I will show you empirical evidence. And later I want to talk about like globally about different policy regimes. So we allow the regulator to change tick and lot sizes. So we first consider uniform tick and lot sizes. So basically, it's like one size fits all. So lot and tick size are the same for all the stocks, but you can change that. And later we will talk about uniform versus proportional tick and lot sizes. So let's go back to BCS. Okay. So here's the basic idea. Basically, it's like okay. They're investors who are uninformed trader. So once they demand liquidity, the market maker in their model is high frequency trader, make a profit, which is half the spread. But the value may change. You can consider that as a value jump. You can consider informed trader as snipers. It's like they snipe the scare quotes, or you can wait longer. As long as they adverse select market maker, result is the same. It's like basically market maker lose money to this informed trader. So this is equilibrium bid-ask spread in BCS. Okay, it depends on investor arrival rate, value arrival rate, volatility, 3 parameters. But let me ask a question. Okay, now what can the firm do? So think about it. 1 share in Budish, Crampton, and Shing can be very large. So now firms can choose nominal price in our model through splits or reverse splits. So H for 1 split means like okay, the P is smaller than VT, okay? Let's say H is bigger than 1. So 1 share in BCS can become H shares. Okay, so now the investor needs to trade H shares. So they need to make a decision. Okay, holding the demand fixed, H shares. How I can trade? I can choose how to slice and dice my demand into H shares. So I can throw all the H shares at the market. And then that's a solution of Budish, Crampton, and Shing, or I can divide that into H child orders of 1 share each. Okay, that's investors. So the market makers choose the bid-ask spread and the number of shares to display. And informed traders, the strategy is adverse select market maker. So what does the equilibrium look like? So it's like investors, the best strategy is to slice the demand into H child order of 1 lot each. They will not submit demand more than 1 lot each, okay? And the market maker display 1 lot at any time. But the question is like, how can you fulfill the demand of H shares? You quickly refill 1 lot once the previous 1 lot is consumed. So what's the intuition? It's like 1 lot depth minimize the loss from adverse selection. So the market maker quotes the lowest spread for 1 lot. Because of that, investors demand 1 lot each time to reduce total losses. And we find empirical support for that. It's like 87.5% of trades are exactly of 1 lot. If bid-ask spread is not constrained by 1 tick. So that means 2 ticks, 3 tick stocks. You will find majority of the trades are 100 shares or 1 lot. Okay. So the bid-ask spread in our model is smaller than Budish, Crampton, and Shing by a factor of H. Why? This is the proposition 2 called the square rule. So basically, it's like there are 2 So basically, it says the spread, if firms split on the continuous price, the bid-ask spread will reduce faster than the split ratio. Why? So it goes back to here. It's like because there's a mechanical drop of H, because your nominal price reduced, but you were less likely to meet mass snipers or adverse selection, and you were more frequently you meet an order from an investor. So that's the reason splits will reduce proportional bid-ask spread by a factor of H. So it's because liquidity provider's loss each time is small. So then how about firm do? Firm's decision actually in this framework is surprisingly simple. You choose a very low price, as low as possible. Why? It's because if the lot size is the only friction, which is in BCS, firms split aggressively to minimize the other dimension, basically minimize the lot size. Basically, it's like you choose a very low price. But then the question is like, why we didn't see so many low price stocks in US? Let's introduce a second part, which is more realistic, is price is also discrete. So price is not discrete. What does that mean? Let's say this is break-even bid-ask spread. This is the spread market maker makes zero profit. Now let's impose discrete tick. So then what does market maker do? The market maker needs to increase the spread to the next tick. We call that a widening effect. But what's the size of the widening effect? It depends on the price. It also depends where you are at the pricing grid. For example, the equilibrium spread or break-even spread in this example and this example, it's the same. But it happens to be this price is slightly above this grid. This price, the bid price is slightly below $5.01. And then the widening effect in this example is very close to 2 ticks. Our model shows that the average actually widening effect is exactly 1 tick. Why is it important? It's important because that means you can decompose. If you see a bid-ask spread of a firm, it has 2 parts. The first part is lot-driven spread. The other part is tick-driven spread. So bid-ask spread on the continuous pricing, if you split, you will reduce the lot-driven spread, following the square rule I showed you before. But if you choose a very low price, your nominal spread cannot drop below 1 tick, no matter how aggressively you split. So that means that creates a force which asks you to go to high price. So what's the objective function? Firms want to minimize proportional bid-ask spread. So one part, which is the tick-driven, decreases with P, and lot-driven increases with P. So the optimal solution is like you need to minimize the sum of these 2 parts. So this one holds inequality only when these 2 parts are equal. So that means the tick-driven proportional spread is equal to lot-driven proportional spread. And then you solve for optimal price, which depends on several variables. Okay, so all firms achieve the minimum proportional spread when their bid-ask spread are 2 ticks. But if you're a large firm, you should choose a higher price. If you're a small firm, you should choose a lower price. But everyone should choose a price when it's exactly 2 ticks. So for example, in this example, if you have low volatility, you should choose very high price. If you have more trades, you should choose a high price. But then the question is like, suppose I met Jeff Bezos. He said, okay, how can I pick Amazon stock? Should I calibrate my model like Maros do, like a calibrated model? Good news is that you don't need to calibrate the model because we have a nice result. It's like tell them how to split their stocks. So actually, the split ratio looks like this. So if you observe your current spread, so the lot-driven part is total spread minus 1 tick. If you do H for 1 split, you will reduce quadratically the lot-driven part. But the total spread is equal to this amount. In the ratio here, it's like, and then the optimal split ratio looks like this. So before we go to empiricals, let me give you a motivating example. So when we write the paper, Amazon's proportional bid-ask spread is 4.8 times higher than Apple, although we think they are similar. Why? So Amazon has $2,100 share price. It has a $1 bid-ask spread. And Apple, $300, 3-cent bid-ask spread. So if Amazon do a 7 for 1 split, so their spread change will be 99 divided by 7 squared plus 1, which is 3 cents. So it leads to the same spread with Apple, and the proportional spread decreases. So actually, our model suggests they should actually split even more aggressively. So actually, they should do like 1 to 10 split. Okay, so now let's go to the empirical evidence. So first, we do cross-sectional. It's like how much can our model explain cross-sectional variation in beta spread? And then we show our 3-factor model greatly outperforms existing benchmark for liquidity. And finally, we use US stock splits as shorts to nominal price. So this is exactly, I just write my model exactly, expand that. So that tells you beta spread minus 1 tick should equal to 2 multiplied by the log price and the log volatility. So volatility has 2 parts. Size of jump and intensity of jump, and also dollar volume. So if you look at this regression in 2019, you will find, okay, first is like square root works. So the coefficient is almost 2. And the second one is you will find that the R square is very large. It's about 84%. So the data fits the model not only qualitatively, but quantitatively. So why? So one possibility is like, think about it. Lots of people ask, what is big data? What is machine learning? Something like that. In this world, in our world, it's like machine make decisions. I guess it's probably we partially recover some liquidity making algorithms. So that's the reason our model actually fits greatly. So now let's compare with other models. So there are 2 famous benchmarks. So one is the Madowan's survey paper, and the other is Hans Stoll's like a presidential address, basically talking about like cross-sectional variation in liquidity. So our model has 3 variables. Their model has 4 variables. Okay, so 4 variables are slightly different. So, but our model in our sample period have a much larger R square. So why? So let's decompose that. The most important factor is like the dependent variable in our regression, liquidity regression, should not be beta spread. So this is my suggestion. It's spread minus 1 tick, because there's 1 tick mechanical part. Okay, so if we change Hans Stoll's model or Madowan's model, and we change the dependent variable as spread minus 1 tick, and their R square dramatically increase. Why? Because canonical models assume monotone relationship between spread and nominal price. And our model captures this important U-shaped relation. And the second thing is like all the models actually control for market cap in their regression. We remove market cap, but we don't lose much. Why? Because market cap in our model is important only because large stocks have more trading. If you control for dollar volume, market cap actually is almost redundant. So you can input that, but R square will not increase a lot. But the reverse is not true. If you control market cap, you don't control for volume, you will have a dramatic drop in R square. So the final test is splits. So splits, our model, remember, it's like splits, we have a predicted spread change. So by the modified square rule. So this is the original spread, and this is the spread we predict after the split. And we use US common stocks announcing from 2003 to 2016. And there are about 1,200 stock splits. And you will find it interesting. Dollar volume does not change after splits. The number of trades increase. So that means splits, after stock splits, they're more frequent arrival of trades. Okay. And then here's a regression. So we have a predicted spread change proportional. And there is also a realized spread change. And we run the predicted realized spread change with predicted spread change. You will find that the coefficient is almost 1. So it predicts almost 1 for 1. That's the first result. Second one is like good news is like most firms split, they do that correctly. Both in proportion and also in terms of magnitude. So we find the majority of splits are correct. So they should split. And the spread actually change is dramatic. They reduce by 15 basis points. And then split is in general good news. But some firms do the wrong split. That means they move away from two-tick optimal. For example, their price is already too low, they still do split, or their price is high, but they split too aggressive. So in general, split is good news, it's positive returns, but correct splits have a much higher return than the incorrect split. Okay, and then we run regression using CAR with respect to the predicted split ratio. Again, this is a predicted split ratio. So 1 basis point predicted spread increase will generate minus 6.25 basis point announcement return. So in general, the announcement return is about 272 basis points. So the correct split ratio explains 95 basis points out of that. So the back of envelope calculation is like a medium US stock value will increase by 69 basis point if it moves to the optimal price. So finally, regulators. Let's introduce regulators to the model. So think about it, like the US market said, okay, we want to increase the tick size from 1 cent to 5 cents. So what should the firm optimally do? What should they do? So we discover something called a square root rule. So if tick size increased by 5 times, let's say permanently, firm should respond by 1 for square root of 5 reverse split. Why? You still want to hold the balance of tick size and lot size constant. So the best nominal spread is still 2 ticks, except now you should choose a 10-cent bid-ask spread. And the liquidity deteriorated by a factor of square root of 2. There's also policy initiative to reduce the lot size from 100 to 1. So then firms should respond by 1 for 10 reverse split, and the bid-ask spread will reduce by 10 times. But the first best policy in this model, is continuous tick and lot sizes. So finally, let's go to proportional versus uniform tick and lot sizes. So these are the solution, what we have already covered, which is uniform tick size, uniform lot size. If you make one of them proportional, the other is uniform, then the solution is simple. For example, if you have uniform lot size, okay, then firms should split to reduce lot size constraint. If you have uniform tick size, and then firms should do the reverse. Okay, but let's think about the other benchmark. It's like perfectly proportional tick and lot sizes. What should firm do? Firm should do nothing, because no matter whether it's split or reverse split, it's the same. But we show actually it's a bad idea. For example, if regulator using any existing stock as a benchmark, for example, let's pick a $10 stock as a benchmark. So it currently has 1 cent tick size, which is 10 basis point, or 100 shares lot size, which is $1,000. So then let's move to $100 stocks. So if you have a proportional system, $100 stocks have 10 cent tick size and 10 share lot size. But it will be bad for this stock. Why? Because suppose its original was optimal. This is a liquid stock. So the original spread is 2 cents. 1 cent from tick constraint and 1 cent from lot constraint. So if you move to proportional tick and lot sizes, so the tick constraint part will be 10 cents. You will reduce the lot constraint part to 0.1 cent, but it's still 10.1 cent bid-ask spread. So what's the main intuition for that? So uniform tick size and lot sizes seems rigid, but actually there's 1 degree of freedom. It gives the firms the flexibility to balance discrete price or discrete quantity. So if you mandate a proportional tick and lot sizes, you actually remove the only degree of freedom. So the first best is perfect continuous tick and lot sizes. So none of them are constrained. If you cannot do that, you choose uniform. So there's only 1 degree of constraint. But if you mandate like proportional, you actually mandate 1 size fits all. So let me conclude. So I want to convince you, it's like small frictions have huge impacts. So a firm's optimal price balance 2 frictions, okay? Discrete price, discrete quantity. And correct split ratio contribute to 95% basis point to the 272 basis point of split announcement return. And a median US stock value would increase by 69 basis point if all the firms move to the optimal price. So the small frictions can lead to economically significant results. So what's the indicator of optimal nominal price, which is 2-tick rule? And we also show a golden split ratio leads to the 2-tick spread. And Finally, we encourage the policymaker to reduce the tick and the lot sizes, especially for tick and lot binding stocks, respectively. Thank you.
I am very honored to discuss this very great paper by Mao Ye and Sida Li, the trade-off between discrete pricing and discrete quantities, evidence from US listed firms. This is a great paper. It addresses some questions with some very important practical implications. In other words, what's the optimal tick size? What's the optimal lot size? If you're an issuer, what's the optimal nominal share price? These are issues in every exchange around the world. And the question, should the company do a forward split, a reverse split? Every issuer faces this question. And this paper develops a very tractable model that actually answers these questions. And I think it's really cool. One of the nice graphs in the paper is what I call the smile and smirk graph. And on the bottom axis, we have the nominal share price. And on the vertical, we have the proportional bid-ask spread. And what do we see? We see very low price stocks have high spreads, very high price stocks have high spreads, and there appears to be an optimal somewhere in that smile. But there's also another weirdness going on here, in that for small cap stocks, it's a very obvious smile. But for large cap stocks, it's more of a smirk. And in recent years, we've seen some very, very large cap stocks not bother to split at all. Now, is this for good economic reasons, or is this just the hubris of the CEO wanting to be a Warren Buffett wannabe? Well, what's beautiful about this paper is that it models the trade-off between a higher price, which ceteris paribus should give you a lower minimum bid-ask spread, and a lower price, which is going to reduce risk for the market makers who are quoting a round lot. Very interesting. But here's what I think is the real money slide here. That he looks at stock splits and says, hey, is this getting us closer to the optimal of 2 ticks or away from it? And the split announcement returns, if it's an correct split, are significantly higher than those with the wrong splits. This, I think, is just a really cool result that really adds to the stock split literature, as well as the optimal price literature. Now, let me go a little bit into the history of this literature. If you assume that the tick size and the lot size are fixed, then it just becomes a question for the issuer of what's the optimal share price. Now, back in my 1997 JF article, I came up with a kind of a stupid toy model in which I basically said, hey, there's a trade-off. Again, higher price means lower bid-ask spread, but I viewed it from a marketing perspective because, as all practitioners know, in the real world, finance is a branch of marketing. And with tens of thousands of stocks available to an investor, there is a very strong need for distribution channels to market securities to investors. And in my model, I basically said, wow, a wider tick creates more vig for the industry to push the stock, both the market makers and the brokers who could internalize the bid-ask spread. So what I did was I mangled Merton's presidential address model and came up with a little model. Later on, Pete Kyle and Anna Obacheva, in their dimensional analysis and market microstructure invariance paper, they modeled both the optimal lot size and the optimal tick size. Very elegant paper, but they have these scaling factors involved. Now, what I love about this paper is it does solve, one of the major puzzles. I think my model did it too, but the larger cap stocks have higher stock prices. And indeed, that can be driven by a number of factors, but higher volume i.e. higher cap stocks are going to have higher volume. They're going to have more liquidity. That means a narrower spread, and that means a higher price. But there's another puzzle our models don't solve. That my model doesn't, Mao's doesn't, because in a ceteris paribus world, if you have a unilateral reduction in tick size, that should result in a wave of stock splits. Well, we had that in 2001. We had a really big tick size reduction. Back in the 20th century in the US, our minimum tick size was $0.125, 12.5 cents. Late 90s, it dropped to 6.25, and then in 2001, down to a penny. Okay, well, if you drop by a factor of 12.5 under the square root rule, that's approximately 3.5. So we should see everybody run out immediately in 2001 and split their stocks. Didn't happen. Now, my prediction was even worse. My prediction was linear. It would have seen 12.5 reduction in nominal share prices. That didn't happen. Okay, as a matter of fact, the exact opposite happened. Not only did we not see a wave of stock splits dried up. So what happened here, and my excuse is ceteris non paribus. Everything was not equal. And in particular, the early 2000s, including the late 90s, coincided with a massive transformation in technology that basically reduced the cost of market making. That we went from a market where in the early 90s, humans traded with humans on a wooden trading floor, and the NYSE had an 85% market share, to the market we have now, where machines trade with machines, and the NYSE's market share is a mere shadow of what it used to be. So but there are all kinds of cool things that you can add. One suggestion is to do a cross-country analysis. In the US, we have a round lot of 100 shares for most stocks, few exceptions. And indeed, you could look at those exceptions as a way to further test the model. In Europe, most of the exchanges have a round lot of exactly 1 share. They've gotten rid of that obsolete concept because, after all, remember, the round lot came from days when people traded physical pieces of paper, and it was a real pain to trade anything less than a round lot. That's why even today we talk about bonds as typically $1,000, because, well, I hold it up the right way, because each physical bond was printed with a par value of 1,000. Okay? But in the electronic world, that doesn't matter anymore. And we saw this round lot gradually disappearing in the US. That around 1990, the NYSE got rid of its odd lot differential. The regional exchanges kind of got rid of their special odd lot trading desks. Outfits like Madoff and Company specialized in trading odd lots because they figured, wow, we can make money trading off of the odd lot traders. Now we see in the US SIP data feed, we see odd lot prints now. So, and then of course we have the recent SEC action to mangle the round lot, which I'll speak about in a moment. Now, of course, the problem is when we look in Europe, we have a round lot much lower. We don't see nominal prices that much higher. Now, I decided to do a little bit of casual empiricism. And so, I looked at the nominal prices of the 3 big small size indices, because it was easy to grab the prices off the internet. You look at the Dow in the US, 30 stocks, mean price of 179, median 174. 425, max 423. Well,
Hello?
can you hear me? Okay. We look at the DAX in Germany. We see that the statistics are lower, that the median's only 85. We look at the CAC index in France, and we see that the median is still significantly lower. Now, I know that these are not representative samples. Okay, so this is clearly back of the envelope stuff. A true analysis would be looking through the entire market, but and indeed, there are many other factors involved. In the US, we have this crude, brain-dead, one-tick-fits-all regime. In Europe, ESMA has a rather elegant, or it might appear elegant, set of tick size regimes based on various liquidity bands. But for the typical stock over 50 euros, it's going to be a penny, and if it's over, I think, what is it, over 100, it's a nickel. That doesn't explain it all. So we've got a model that's given us tremendous insights and tremendous progress, but the cool thing about research, as Robert Pirsig taught us all a long time ago, is that every research brings up more questions than answers. That's what makes it fun. Now, I'd like to add yet another consideration. Not only do we need to worry about the market makers, we talk about the firm choosing the price. Well, there's another thing that a firm wants to think about. How are they going to manage their shareholder base? Now, turns out there are a number of shareholders who will have very, very small lots of shares. People like me. I'm your classic small investor. Actually, I practice what I preach in my investments class in terms of diversification, and I do direct indexing, which means basically I literally have small positions in thousands of stocks. And I'm sure many issuers would love to get rid of small shareholders because they're expensive to service. Now, even though I get most of my shareholder communications electronically, for some of the stocks in my collection, I get them on paper. So for example, here is a merger document from one of the stocks that I own. And as you can see, this thing is 3 or 4 centimeters thick. It is not cheap to print these and mail them off to shareholders. It is costly to send out communications to every individual shareholder and to collect their voting instructions. So, from time to time, some companies will even do a mini tender to try to get rid of small shareholders. I've seen companies do reverse splits followed by forward splits to shake out all of their small shareholders, basically to make it less costly to service them, or in some cases like Parker Drilling, because they wanted to delist from the US markets, and by shaking out the small shareholders, they could get below the registration requirements and thus delist. So think about it from the issuer's perspective. Well, one question I have is wow, what is the revealed preference of shareholders for their lot sizes? Not in terms of number of shares, but in terms of number of dollars. Well, one way to do this is to open up the shareholder registries and say, aha, what is the distribution of shareholdings? This is not readily available information in the US. It may be in a few other countries, but there is one market infrastructure firm that has this data. They are called Broadridge. And they are that Harry Potter institution that touches every investor, and most investors are unaware of them. But what they do is they basically provide shareholder communication solutions for brokerage firms. So most shares in the US are held in street name. So when an issuer wants to communicate with their shareholders, what they basically have to do is to work through the brokers, and the brokers outsource all this to Broadridge, because Broadridge is very efficient at doing it. And indeed, shareholders in the United States have the right of privacy. One of the few areas in the US one of the few areas where the US actually has some privacy rules. And so if a shareholder is what we call an OBO, an objecting beneficial owner, the broker is not allowed to tell the issuer who they are. So US issuers are always complaining, we don't know who our shareholders are. But Broadridge knows. And and from time to time, they put out various statistics on shareholder voting. I suspect that if somebody could convince them to cooperate with some academics, they might also actually, give us some information on holdings, because they definitely put out statistics from time to time on, the distribution of shareholder votes. Now, this is an area where, Mao, I think that you would be perfect on this because you have this amazing talent to pull together resources that, whether it's funding, whether it's people, whatever. I don't know what your magical skill is, but you've got the talent that if anybody on this planet could get Broadridge to do it, I am sure that you could. Okay. Now, it may also be easier in some other countries where, they consider shareholder records to be either available to the issuer, where some issuers might be happy to give you some data, or may even be public knowledge in some countries. But that would be something I think would be really, really cool to look at and to help answer the question.
Jim, I'm sorry we're out of time. Maybe we can
okay.
Put the remaining comments
40 minutes after the hour.
In the break later when you can
keep
talking with
all right.
Mal.
Well, let me just can I have one more minute?
Okay.
Okay. I thought we we're going till 40 after the hour. I apologize. Policy implications. I think the US should follow Europe and get rid of the stupid, archaic round lot that we have. In my comment letters to the SEC, I put in details on that. As far as tick size go, let's think about who has the skin in the game. Who has the knowledge? It's the issuer. We should let the issuer pick the tick size from a menu that it's easy enough for the exchanges to implement, and it gets the exchanges and the regulators out of the business, and because they usually do a fairly crude thing. One random thought, this 2-tick solution. Oh, if the NASDAQ market makers only had this in 1992, as many of you know from history, there was a big scandal. I see some people, I see Sida smiling on this one, that they basically colluded to keep spreads wide at 2 ticks, and this would have been a great defense for them. And just one tiny nitpick on the paper. Yes, now you can buy fractional shares through a lot of brokers. You can't do it on the exchange, but the market makers do it for you. Once again, this is an amazing paper. My hat is off to Sida and Mao. You guys did a great job. Thank you.